Welcome to Market View with Ike Iosa and Friends. This show that not only reveals and analyzes the inside story on today's market news, but also uncovers the areas where investors can make money right now.
Gentlemen, good morning. Mike Iosa, your host for my guest, my very good friend, Mr. Mark Arbeter. Hi, Mark. How are you?
Doing well, Ike. How are you?
I'm doing well and curious to hear your thoughts on the markets. The S&P, since the last time we spoke, is up 300 points. And most of the heavy lifting has been done by a handful of stocks. So I'm curious, how long can this go on? What is your technical work telling you?
I think we're in the process of topping from at least a short, if not intermediate term perspective. As you said, a handful of stocks have done or contributed to certainly the S&P 500 performance, the NASDAQ and the NASDAQ 100 performance, mostly in the tech area and mostly in the semiconductor area. So if we take a look at the first chart, it's a daily of the S&P 500 with the 513 EMA on it, along with the 50-day and then something called an SAR. And if we look at the price action, maybe over the last 6, 7, 8 days, the market's had a tough time here staying above the 5,500 area. One of my targets was 5,600. We haven't quite got there, but you can see, there's been at least 3 days here recently where we've seen some decent amount of intraday selling on strength. It's usually a sign of institutional selling and profit taking. Nothing has broke down price-wise. On the daily chart here, the 14-day RSI, which is the top panel, that's, we got overbought. We have a lower low, but that's actually not a bearish divergence because the 14-day RSI is based on the close. And the highest close occurred on June 18th, which was the peak in the RSI. So we haven't had a higher close, so you can't really call that a bearish divergence. And if you look down, we did have a bearish divergence if you go to the panel 3 on the MACD histogram, and that's based on the highs that we saw in the middle of May versus the highs we saw, as I said, in the middle of June. 14-day ROC, rate of change, is still positive. That's one thing we watch for a intermediate term breakdown if the 21-day goes negative, but we're still a pretty good distance from there. So no real price deterioration. We haven't even broken the 13-day EMA, and we certainly haven't seen a 513 cross. But I think the market's tired up here. And then let's move to the next chart and step back here. It's the S&P 500 on a weekly basis. It shows the bear market in 2022. It shows the massive cut that was formed in 2022, 2023, and then the breakout in the latter part of 2023. And you can see we have run, there's a pretty good trend line on the top trend line of this channel. And I think the longer I'm in this business, the worse I hate these trend lines, or drawing trend lines anyway, unless they're horizontal. But anyway, this is a pretty good trend line. After it started to form, it's been hit 3 times. The first 2 don't count because it takes 2 to start the trend line. But we've run right back up to the top of the channel. Sometimes that can cause some problems for the market, especially considering the run that we've had. If we look at the bottom 2 panels, we see that the S&P 500 is way above its 50-week exponential moving average. That's the panel right below price. We're about 12% above the 50-week. And then if we look at the bottom panel, almost 30% above the 200-week exponential. Now, we can get more extended, but based on history, this is many times about as far as we go, as far as being extended from these longer-term moving averages.
Okay.
Moving to the triple Qs, which is chart number 3, we've had pretty glaring divergences on a weekly basis. We've had 2 of them. One happened at the last high, and then the other one happened back in March. If you look at the top panel, we're still overbought. It's been a very, very impressive advance for the NASDAQ 100 triple Qs. We're also working on a third bearish divergence on the weekly MACD, which is under the panel under price. And I have the same 2 panels here at the bottom. It shows the percent of Qs above their 50-week, or it shows the percentage above the 50-week for the Qs, and same thing for above the 200-week EMA. So we're 17% above the 50-week, and we are 43% above the 200-week. As I said with the S&P, this is about as stretched as we get. We can get further overbought, but we're knocking up, against an extreme overbought condition here for both of these major indices. We go to chart number 4. This is the iShares Semiconductor ETF, known as the SOX. This has led, these stocks have led the major indices higher, done the heavy lifting, but we do have a potential bearish divergence on the weekly as far as the MACD is concerned on the top panel. And what worries me a little bit, starting to worry me, is that although we're still in an uptrend, nothing has broken yet, the slope of this advance continues to get steeper, and that's a sign of, excess bullishness. People are just chasing these stocks, and you can only go so, when you get very steep, you only go so far without, some kind of crack happening. And the volume of the panel below the price, you can see the volume has dried up. Strong outperformance by the SOX, versus the Qs. And not too long ago here, the SOX was back in February. The SOX was 32% above its 50-week exponential moving average, and currently we're about 22%. So even more extended than the other indices, of course, because this has had a better run. Moving to chart number 5, this is the NASDAQ 100 or triple Qs. The stock's above their 200-day moving average. That would be the middle panel, second panel. And you can see since about early this year, as the NASDAQ 100 has grinded higher very consistently, the percentage of stocks in the NASDAQ 100 above their 200-day moving average has consistently deteriorated. This is not uncommon. The longer a move goes, the less and less stocks are technically attractive. And if we go down to the bottom panel, we can see the same thing. The percent of NASDAQ 100 above their 50-day hit 95% late last year and has settled down to about 63%. So if we go back to the middle panel, 65% above their 200-day is still kind of acceptable. I wouldn't want to see it get, too far below, the 55-60 area, and maybe even a little lower. That's where the market usually has some intermediate term issues.
Okay. Well, Mark, anything else you'd like to add?
Yeah, I'm going to take a look at silver and the U.S. dollar, which nobody seems to be talking about. The dollar has been in an uptrend since late 2023, early 2024. And at the same time, both silver and gold had these very large moves. Silver had a couple parabolic moves here, but since, over the last month or so, silver had a couple big reversal candles, has been in this down trend channel. We've retraced 38.2% of the move since early March, and we've also hit the rising 50-day EMA. This is around the 2650 area. I still think we got more downside for both silver and gold. So the next two areas I'd pay attention to would be a 50% retracement, which is around 25, and then a 61.8% retracement at $24. And that's also the location of the rising 200-day EMA. So that's also an interesting spot. I think once this down move is over and the dollar stops going up, I think the metals will reverse and make new highs, new all-time highs for gold and new highs, recovery highs for silver. One interesting thing, the COT data for silver and gold is terrible. The COT data for the dollar has been very good since the rally started. However, in the last couple weeks, the COT data has deteriorated, so I don't think it's as positive, certainly not as positive as it has been, and it's kind of a warning here that the dollar in the next couple weeks, months, will run out of steam here if the COT data stays the same, and that would be a very big boost, I think, for the metals.
Mark, thank you. Have a great weekend.
You too, Ike. Thank you very much.